I've known Brian a long time, and uh, I've always liked Brian. I don't know if it's just because we both grew up in the Midwest, but
Mhm.
I like Brian, and we talk sports. We've done a lot of seminars together. Brian's one of the better teachers in the option industry overall. As always has been. Um, Always gives, I say, sane information versus insane information because he's always thinking of the risk management. So it's never like, go sell puts and walk away. It's not like there's sanity. And I wanted just a couple things, and then I'll let Brian talk. One, bring up what he's doing now, how's life been, and maybe bring up the website if you have it of the Brian basically, and I'll let Brian tell the story, but he has, the Options Playbook, which I don't know if it's the highest selling book but it's to me the kind of standard book for option traders. Maybe different than a Macmillan book is different. But the Brian book, and he can bring up the website, show you what he's doing on that. And then I asked Brian to kind of talk about like today, it's Friday, or maybe his favorite strategy, focusing on the risk management, how he handles it, or if there's a trade for today. Obviously, in our
Hold
community.
on. I came up with something for today.
Good. Perfect. All right. So, Brian, why don't you maybe, if you want to share your desktop? Yeah.
All right.
Perfect.
Hello. Hi, everybody.
Yeah. And I'll try not to get distracted and say, Brian built, I looked at that picture last week
Yeah.
when I was doing something with Brian at Tradier, and I said, Brian, that's beautiful. Oak behind you. And tell him what you told me. What is it? That's not your house.
No,
Explain.
this is a tiny home. Yeah. I ended up, I live on a lake in Lake, I live in a town called Lake Wiley in Lake Wiley, South Carolina, on Lake Wiley. And I had this shed in my backyard, and I ended up turning the 16 by 20 foot shed into a tiny home. It's actually got washer dryer. It's got two heads in it and a small little garage. So yeah.
It's almost better than a man cave, isn't it? Like
Oh yeah. Oh yeah, without a doubt. Like I got a little kitchenette in here. I got a dishwasher, a little refrigerator.
So if
Right
you
here,
get mad at
actually the
life,
bathroom.
you're set. You're
Oh
set
yeah.
for a couple
Well,
of
I'd say it the opposite way around. If she gets mad at me, I still got a place to go, right?
That's right.
I built my own doghouse in the backyard.
Well,
Hmm.
well, all right. Well, Brian, why don't
Okay.
you, if you want to share your,
Okay, so I'm going to share. All right,
yeah,
let's do that. All right. So, Dan, what I came up with today, if we're going to talk about just a trade,
yeah,
you and I, and we had a great show on Options Guy TV, which is also
yeah,
in the Tradier YouTube. Last
yes,
week we had a great discussion. Of course, it was supposed to be a half hour, and we went almost an hour, as always
yeah. I
is
wonder why that,
the
yeah, here.
case. Uh, so that week we looked at a skip strike butterfly, and that is one of my favorite trades. But now the market has changed a little bit, and obviously we had good jobs numbers today. Well, I guess it was like the perfect mix, right? The numbers were solid, but it was all about the revisions. It makes it look like we're going to probably have a rate cut going along with what Jay Powell said this week. So I think it made the probability of that rate cut happening in midsummer more likely. And so the markets have responded strongly to that. Today we're down a little bit, but I would do this trade on Monday. I don't want to do it over the weekend, but it's a real simple trade. And I think this is one of the trades that, gosh, I'm going to say about 5 years ago, I put this trade together for the class in Chicago at the Gleacher Center.
Oh, wow.
So we looked at this trade, and it's a very simple one. And I know that we have a little bit of a short time period, and I did want to give the adjustment. So I decided, and I might actually do this on Monday as opposed to a skip strike in the SPX or whatever. And
Yeah,
my screen looks good, right? I'm looking
yeah, yeah,
fine.
yeah.
Okay,
Perfect.
so this is the Trade Hawk software with Tradier, who sponsors my podcast. I
That's a
don't
nice
work.
software. Yeah.
Yep. Yeah, it is. It's solid. Okay, so market rate here is at 51.49, and I was actually looking at the adjustment when I had this trade on. So let me remove this. And all I usually do in these SPX trades, and you can do them on a little bit of a smaller basis, but if I want to get bullish for the week, I like to just do a long call spread that is positive time premium. So in other words, I'm going to go in and I'm going to buy the 51.40 and I'm going to sell the 51.50. Now, at this point in time, we have a net debit to the account of $535. But if you look at this and you just look at the intrinsic value, we're buying $37 worth of time. No, that is the 7th. Okay, I want to make sure we got that weird SPX thing going on, right? Where the normal SPX happens on March 15th, and then also you got the dailies that the SPXWs or the weeklies. So you got to be careful of that. You know what I'm talking about, right, Dan?
Yeah, oh yeah.
Got to be very cognizant. I've done that many times where I've traded this one that's in green as opposed to the SPXW. Okay, I digress. So I put this trade on $5.35, which means that if the market stays right here, it's positive time premium. So the market can stay right at, oh, the market moved on me, dang it. It was 51 before we started this. Now it's right in the middle. Okay, I'd rather have this be at 51.50, but I'm just going to keep rolling here, right? So if the market just basically stays where it's at, this is going to be a positive trade. This is going to be it's going to be profitable just from time decay because we're buying $37.27 worth of time premium and we're selling 41. So even though we're paying a net debit, time decay is our friend in this trade. So now if the market actually goes up, well, it's a no-brainer. You get let's say a 0.5% move, which is about 40 points to the upside. If that happens, well, life is good. But if the market goes down that amount, I want to look at rolling this into a butterfly. So it'll be straightforward that we're going to roll it into a butterfly and we're going to give ourselves a chip in a chair. We're only going to make one adjustment to the trade, and it's all going to be based off of where that net credit is at. We're not really looking at where the market is at. I want to see what I can sell the short spread for that trade. So we start off with a long call spread, which in a butterfly, that would be the first part, the first spread in our butterfly, the one that does all the work if we're correct on our forecast. And then we'd go out and sell one more of these and buy one of these, okay? And then, so envision that the market goes down. It would go down probably about 30 or 40 points before I would do the adjustment. And then we sell that and we roll it into a butterfly. It's only 10 points wide, and it's all about, sometimes I'll do them 15 points, but I like to keep the initial risk fairly low when I'm teaching the class. But it would be 50, and the only downside of this is that butterflies just really won't pay you until you get a little closer to the expiration. But with that said, we're going to go back and we start here. We have this position on, and I usually want to do it on a Monday. And I'm going to go 5 days. I'm going to put this on for a net debit of $5.70, knowing that if the market stays where it's at, we're good. And if the market goes up, we're good. So we got two scenarios where we make money. It could even go down a smidge. The break even is going to be at 5140 plus 570. So 45.70 is going to be our break even. So the market could even go down and we're still going to be a little bit profitable. And I love this about the SPX. Like we got the VIX at 1489. That kind of helps out a little bit. We're selling all that juice on that at the money option contract. Now, if the market goes against us, here's what our trade's going to be. We got this position in our account, and all we're going to do is sell one of these, an additional one, and then buy this one. And we're at 525 right now. That means that if you put this butterfly on, it's going to be a very small debit, but we're going to sell this spread when this gets down. We had 570 for the initial trade. When this is trading for 370, which means it's going to move about 40 points against us at this point in time. Obviously, it changes as the expiration changes. But on the open on Monday, if the market goes 40 points against us, we're just going to roll into a long put spread or a long call butterfly trade. And then we just have a chip in a chair. And then we're going to let that trade ride. You can decide to get out if it moves against us, but I just like making one adjustment. It's one way that if I'm more bullish on the marketplace than anything, that I can get long the market. I feel like the markets on Monday might be good. This is the trade that I would put on, and that's how I would adjust it. So let's walk through it one more time. And I actually can start by, let's put all, so market's at, there we go, 51.49. I like that a little better. We're going to go in, we buy the 51.40, sell the 51.50, net debit of $5.60. We'll call it 570. That's what I had in my notes when I was setting up the trade. And then we wake up in the morning, market goes down. If it goes down about 40 points, that would be similar to this being 40 points out of the money, right? So here's what I'm going to do. I'm going to adjust it, and we're going to sell the 590s on the bid and buy the 5200s. That's about 40 points. All right. So that's selling for, well, close to 350, 360, 370. Okay. So what I just did was it created a scenario where the spread would be 40 points out of the money on the downside, right? So if the market opened down, you could sell this for about 360. And all this adjustment does is give, say, I don't want the cheese anymore, just let me out of the trap. Because here's what the way I look at this, Dan, is a lot of people go and they put on these trades and they won't sell them. They get hung up on it, and they're like, as to use an analogy like you said, the Bollinger Band ran into the moving average and hit the Fibonacci. So how could I sell at that point?
That's right. That's right.
So in this instance, it's an alternative to take some of the risk off the table, but still give you a chance to be in that position. So if we go all the way back to the beginning, if the market goes against me, this is my adjustment. And then that would probably be on a Tuesday or a Wednesday. And then you just hope the market comes back and it lands within your wings. So we start with this position, scroll back down. Let's hope it's still there. It's close. So we start by buying the 40s, selling. That was the wrong one. Buying the 40s, selling the 50s. The market goes down. We sell another 50 and we buy a 60. And we end up in a butterfly for the duration. And then I don't care when you get out because you already adjusted your risk. So you start with about $5.70 worth of risk, or $570 for every 1-by-1 long spread you put on. Market goes against you. You bring in a net credit of about 370. So when that spread is trading around 370, $2 lower, then we put that on. And now you just kind of hope the market comes back. You're down about 40 points. You're trading somewhere down in this range, right around 5,100. You hope it comes back and lands within these strikes. And I don't mind doing this 15 points wide and doing the same scenario, but that means you got to put on a little bit more risk to start with. But you got a better chance of your chip in the chair on your adjustment of the market coming back and landing within those strikes. And if it does come back here and you can get out, and this is what I mean by I don't want the cheese anymore, just let me out of the trap. If I'm down $2 on that trade and the market comes back and I can sell this butterfly for $2, I'm going to probably get out. I'm just trying to salvage the position. Yeah. Maybe I stick around, try to get 3 on a 10-point wide butterfly, but then you got to be closer to expiration. You got to be on expiration Friday to try to be able to get $3 out of a 10-point wide butterfly.
Brian, what is Sid says, and I like that saying. This is very thorough, which is typical of Brian, which is great. What's chip in a chair?
Chip in a chair. That's poker. That's like if you're playing, and I still do play a lot of poker, I have to admit. But if you're playing Texas Hold'em and you're in a Texas Hold'em chair tournament, you're not out until you're out, right? So if you go all in and you get busted, you're out. But if you go 90% of your stack that you got left, you still got 10% left, and that's what we call a chip in a chair.
I love it. I love it.
Right. So you're sitting in a chair and you got chips in front of you. That means you're not out.
Yeah. Too funny. Sid, does that Sid, did you ever know that? Yeah, that was good stuff.
I'm sure Sid knows that.
Yeah.
So you're
So
showing your hand, so you don't play a lot of poker. I take it.
that's right. You showed your hand.
Yeah, I know Mr. Sosnoff plays a lot of poker, and I did watch that interview, and I want to take the other side of Dino's trades too. So if they get that exchange up and running,
Yeah,
I want to be on the other side. So
yeah,
I know Dino's in here. I heard Tom offer that up to you, Dan,
yeah.
during your webinar with him,
That's funny.
Mr.
Yeah.
Sosnoff.
Well, folks, any other questions? I think that was very thorough, and that'd be a good trade to possibly. Brian, you said you'd put that on Monday, right?
Yeah, if I'm going to do the long haul spread, if I want to, I'd rather do it on a Monday. I don't want the weekend risk. I don't mind that as much as the trade that we talked about, Dan, where you got a little bit further out, and you're doing a butterfly on one side and a calendar spread on the put side of things. I don't mind being a little bit further out on that. I still like to try to avoid weekends as much as possible, right? If you're trying to get the time decay in the SPX.
Yeah, it makes a lot of sense. What okay, yeah, that's a good and
Yeah, so you're not trying to, your adjustment here isn't for the home run. This is a simple trade. This is very, very easy to do, right? It doesn't take a genius. You got to be bullish on the market in order to want to get into this trade. So if I'm doing my weekly trade in the SPX, every once in a while, this is the weekly trade. In November, as a matter of fact, if you go all the way back to Options Guide TV and watch the November shows, we did like 5 of these in a row after we got through September and October and wanted to get long the market going into Christmas. We did 5 of these in a row and they all paid. Obviously, you do it until it works until it doesn't, but that's the concept of this trade. And you put it on. And I like to go 15 points wide, only because the butterfly pays a little better. But I don't know. Starting out, I would start out at 10 points if you haven't done it, and work it that way. But if we did 15 points, Dan, we're at 46. Okay. So if we go 15 points, we'd be selling the 45s now because it moved down a little bit. And it's always going to be about half of it. Whatever the width of the spread is. So if it's 15 points, it's going to be $7-8, about half of what the cost is. And that happens in the SPX. Usually you got to straddle the stock to make it a 50-50 bet, right? But in the SPX, because there's so much juice in the option contracts, so we hit this 15 points lower, we're looking at 30, and that's 865, right? So that should be, I was guessing it was going to be around 8, but it's a little bit more than that at this point in time. It's probably because it's, I don't know, because it's Friday or Monday. I thought it would be $8, but right here, you're now risking 865 on a 15-point wide spread. And if the market it's 44, it's a little bit down. So if the market just stays where it's at, you're obviously profitable on the trade. But then when you do the butterfly switch, you're going to sell one more of these, right? And that makes that 2. And then we're going to go 15 points higher. And you're going to buy that. Now you got a lot bigger landing area on your butterfly, and it's going to pay you quicker. That's the biggest thing, is that this will be 5 points in the money. If it comes all the way back to 51.35, you're going to be doing fairly good on that butterfly, because this option contract is going to get deeper in the money and offset the 2 that you have to buy back at the 51.45s.
Okay.
It's a simple trade. It's a simple trade. You want me to put something together? This is the alternative to always selling premium. We are, though, kind of selling premium, right? Because we start out buying less time premium than we're selling. So time decay is our friend on the initial trade.
Yeah. No, I like that. I mean, it's when you're starting it out, like right there, it's a balanced butterfly, right?
Right. It's balanced, and I want to stay balanced. So you could do a skip strike, but then you're starting. I'm just trying to keep it simple, right?
Yeah. And that's not, the nice thing is what's the capital on that one? That's cheap. Right?
Well, to start off with, it's weird. The capital infusion, if you will, gets lower as the trade goes on. So you start out, let me go back. I think made a little bit convoluted when I switched to the 15.1, but that's more what I would do. But in this instance, I would buy this, sell this, 140. Oh, now we're back to 51. Could you make the market stop moving, Dan?
Yeah, I know. That's the problem. I know when you're teaching and it's, the SPX is moving all over the
All
place.
right, so we're here. So this is where it would be. So your capital on a 1x1 is 575, knowing that you're not gonna allow yourself to lose that, or it would have to be a huge gap down in the SPX for that to happen, like a 1% or a 2% on the open gap down, right? And that just
Right.
doesn't happen that often. So I'm doing this. This is 575. When we roll into the butterfly, it would be when that spread got down to about 375, and my goal would be to only lose $2 or 200 on the trade. That would be the maximum per situation, per gaggle of options that you put on.
For gaggle of options that you put in.
Yeah.
No, that makes sense. Any questions on that? Let's see. Sid says this trade would have worked well over the past months.
Yeah, and it did. And you could go back, and if you watch Options Guy TV, you would see that. What's the trigger to adjust? Karen asks. It's literally the spread. I'm just telling you the adjustment's going to happen from with the VIX at 14. It's going to happen about a 0.5% down, which is about 40 points right now in the SPX. That's when the adjustment's going to happen. But I'm basing the adjustment 100% on what the second spread is trading for. So I'm going to take this off, right? This right here, the 5150 by 5160, we're going to sell one of those and buy that. And that's trading for 535. So when that gets down to 370, when it goes against you and is trading for around 370, that's when I'm going to put the adjustment on.
Okay, makes sense.
Okay, and so I can actually show you that, and this is just using the current chains to try to teach the concept. Like I said, it would be about 40 points. So 40 points higher from 5150 is going to be 5190. That's about where so if we look at that spread, that will act very similar to if the market opens down. Now it's using today's markets, not Monday's market, but this is the way we would do it. So if I clear that out and I look at, this is the old tricks before the profit and loss calculators, right?
Yeah.
You go 5190 and you go here, now that's 40 points out of the money, and boom, look at that, straight in for 360, right?
Okay.
So if the market went against me, this is when I would put that spread on, when it was about 40 points out of the money. And that's going to adjust as time decay happens, but there you go.
All right. Well, Brent says, do you use the same two loss when you do a 15-point wide spread?
Yes. That's simple. I mean, it's all about the risk. I don't want to lose a couple of, if I'm going $8, I don't really want to lose $4.
I got
So yeah, I'm going to shave the risk. It might be a little bit closer to 250 or 3, but I don't want to shave that entire risk. And it's still going to be a very similar amount of a movement in the SPX to the downside before you're going to adjust that trade.
Okay, and then the last one, Brian, or did you wait? Did you already answer that? Karen's, did you ever change
Yeah,
the?
I got Karen's.
You got
right.
that. And then Kevin says, if the market reversed down fast, do you ever place the put spread farther down so it is more like a condor versus a fly?
Okay, well, we're not in the puts though. We're not in the puts. We're in the call. So we're on the call side of things. So I think in general, if the market reversed down fast. Oh, do you ever place the put spread? Oh, I understand. I guess he's right to be on the put side of things. Right?
Oh, is
Because
it?
you're saying
Okay.
you're going to use the puts instead of the calls? You said the call spread. Okay. No, I don't. In short, I don't. I don't roll this into Iron Condor. You got to realize that if you did, it wouldn't be an Iron Condor, right? Because you'd be long the call spread and short the call spread, which would just be a condor. It would just be a call condor. I really just stick with the butterfly. I don't get too convoluted with it. That simple, right? Because the market's already gone against you, and I need it to come back, and I want to do it for a net credit. I don't want to add any more additional risk. So all the risk is up front here. You're not adding any margin requirements by doing it. All you're doing is a very simple adjustment, giving yourself a chance to get your money back. Not the alternative to this trade is you close it, right? That's the alternative. You just go on out and you just close the trade. And that's what my alternative trade would be. And that I would just do risk management that way. So let's go back to the initial presence in that there's a lot of people that will put on a long call spread and they just don't do anything. They don't want to give up on the trade. They don't want to close it out as a risk management. So this is one way that you can take a lot of the risk off the table and still have a chip in a chair and still have a possibility to get your money back.
All right. Sid says this would be much harder to get away from you.
Yeah, I mean, you're right. If I put this on, people are going to be more apt to do this, right, Dan? In that I'm not taking the trade off. I still got to. So if you really, instead of playing the hope game, gosh, I hope I'm down 40 points in the SPX. I'm down 0.5%. I really hope that the market comes back. You're doing something, and I don't want to adjust it anymore. I'm just putting it on once. And heck, I don't even necessarily have to watch it. I can set an alert for 51.90, and if it gets there, that's great. If not, I lost $2.
That makes good sense.
Mm-hmm. Usually done for DTE. Yeah, what I would normally do is put it on Monday, which would be the 11th, and I would use the 15th option contracts. That's what I would normally do if I was doing this trade. But this trade does work. You can do it for 2 days now. You know, it's possible. You have so many expirations. I mean, honestly, I do it this way because this is the way I've always done it. But yeah. I don't know. You need to be able to make an adjustment. So I could see doing the March 14th expiration. Now I'm thinking I'm just throwing stuff off against the wall because then, so you put it on the 11th, you adjust it on the 12th if it goes against you, and then you still got 2 huge days of time decay, the 13th and the 14th. So I wouldn't mind going out to the 14th if I put it on the 11th, but I don't want to do too short term because then you just don't have any premium to adjust it with.
Makes good sense.
Does that make sense to you, Dan? What I said, I hope I explained that okay.
No, you did. Yeah. Folks, if there's any more questions, if not, I want to have Brian maybe, if he's got a minute or two to just show the Options Playbook site and go over that a little bit.
Okay, so we did something new, and so I'll give a little bit of background on this too, by the way. At Ally, had many great years. I was a founder of Trade King that got bought out by Ally Bank, or Ally Financial is a better way to say it. And they are going in the direction of more money management. So I did have a conversation with all the powers that be, and they were absolutely wonderful in my mind. That their motto is do it right, and with me, I feel like they did. They allowed me. They basically said we're going in a different direction. We're going towards a little bit more on the money management side of things, and so you're no longer in the picture. I'm just trying to say that kindly. But they allowed me to buy my work product. So I've had the Options Playbook that has been a tremendous success since it was written. And Dan kind of mentioned we brought the book out. We went to paperback because Amazon now, there's no inventory at all on the paperbacks. It's actually print on demand. If they buy it, they start printing it and you get it in about 10 days. So last week or this month, actually, now that it's my corporation, I am now the founder of Options Playbook Incorporated.
Wow.
And Tradier is one of the main sponsors on optionsplaybook.com. And there will be more. There'll be more to come. As a matter of fact, Dan, you actually didn't know this. Friday, there's going to be a brand new website with a whole new look. It's going to be more mobile friendly, and
Yeah.
that's all happening this. I'm sorry, this Sunday. Sunday.
Oh,
We're
wow.
that out. Yeah.
That's
So Monday
nice.
morning, you got to check out optionsplaybook.com, share it with friends. And if you click on the link from optionsplaybook.com, we actually get a few more pennies in our pocket for buying the playbook. But the paperback is $14. As a matter of fact, I can send you a bunch of them, Dan, if you want to send them out. They're real easy for me to do on a author situation. And I'm looking to add some management things to the book and do a third edition. Like this little trick right here would obviously be an easy chapter to add to the options playbook on management.
No, that's neat. And I think that's it's just a good book in general. Uh, uh, see, that's people in our community. They're great. Like, it's just like saying, Brian, can you talk about your entire life? Just a quick, 30 seconds. Sid's like, can you talk about the skip strikes just for a moment? So give Sid like the 12-second. Sid, how would you define? See, Sid, we asked you about chipping a,
Chip in a chair. Chip
chipping
in
a
a
trick.
chair.
Sid, in your world, Sid, what is a moment? Give us, Sid, what's the definition of a moment in your world? How long should Brian talk about the skip strike? 2 minutes. All right. Brian, can you give a 2-minute version of the skip strike butterfly?
Okay. And I didn't pull up the options playbook. So go to optionsplaybook.com and check it out. That's the moral to my story. A skip strike butterfly. SPX. Okay, so in the skip strike, if you're going, like right now, if you put it on Friday, you go one standard deviation out, you're going to be able to get this done for about $1, somewhere between $1 and $1.50, I think. So if we wipe this out, we're at 51.50. Inside the TradeHawk software in the options grid, they highlight a one standard deviation move. Let's go to here. And just going off the cuff, where this starts, where the gray line starts, is about a one standard deviation move, and you can confirm it by looking at the delta. The delta between this strike and this strike is 16 and 15, right? So we're going to grab the 52.50s, and we're going to sell the 52.50s. And we're going to buy the 60s. Once again, 10 points versus 15 is the argument. But this will be cheaper with less risk if I show it to you this way. We're skipping the 52.70s. That's why I call it a skip strike, not a modified butterfly, because if we bought this strike, it would be a standard butterfly. I like skip strike better because it defines the strategy better. And then we're going to buy this one. Okay, so let me start that over. Buy, sell, skip, buy. Everybody can see that, right? I'm still sharing my screen, I hope.
Yeah.
It's not quite $1. VIX is up a little bit. I'd like this to be $1, but it's not quite. Maybe I got to go down to the 52.45s, but you get the gist. So in this scenario, I build a skip strike butterfly differently than people usually do it, in that you're saying, and they call it that way. They say it's a modified butterfly or it's an unbalanced butterfly. I look at this as an alternative to a short spread. So I'm bringing in 75 cents by putting this butterfly on. What I'm really doing is I'm selling a short spread to pay for the butterfly. By skipping the strike, I'm literally selling a short spread. So let's take these two legs out and look at that short spread. We're going to take this one out. We're going to take this one out. We're going to sell this one. And so in this instance, the 52.70, we're bringing in, wow, I'm surprised. I thought that was going to be more. So that's trading for $1. Okay, so let's look at these two scenarios. I'm selling, I got this right. We're selling a short spread, and we do not have, we're just naked short the spread. And that if the market starts going against us, we can roll it, we could do whatever, but it's going to start hurting right away if this market goes against us. and we're bringing in a net credit of $1. Now, if we switch this up and we do the skip strike butterfly instead of the short spread, we're already putting our hedge in the trade. So it's just a different way to think about skip strike butterflies. So if I'm thinking about doing a short spread and I got up fairly like an index like the SPX, it's only going to work fairly well if you got some premium behind the underlying. So fairly expensive underlying stock or whatever. You say, I'm going to put this trade on and I'm going to put my adjustment in already. So my adjustment already is going to be that I'm not going to do the short spread. I'm going to do the skip strike butterfly. So I'm going to start here. I'm going to sell this one. And I'm going to skip to 52 that. And now I'm bringing in a 70-cent net credit as opposed to 95 cents. And my hedge is already there, right? So if we go to the what if calculator, and I'll send this to the what if, it'll paint a better picture. It's still going to hurt if it goes against you right away. So this is the TradeHawk software what if calculator. If it goes against you right away, the market's right here, it's still going to hurt. But if it goes this way closer to the expiration date, let's put it on Thursday, now it doesn't hurt as bad. And this is doing it as of 12 o'clock, 12:42. Let's go one more day. Now we're profitable, right? So now your guessing game becomes, if I put on the short spread and it moved that hard against me, I'd have to get out or roll, right? There's no way that I could just hang in that short spread. If I do the skip strike butterfly, now I can kind of play the hope game. Gosh, I just hope it stays here because 2 days ago it wasn't profitable when it was trading here, right? Where is that one? Yeah, and then it wasn't profitable. Now if it can just stay there and the expiration approaches, well, boom, all of a sudden it is profitable. So if you're sitting right on this inflection point, you can kind of play the hope game a little bit more. But here's my golden rule. If I do a skip strike butterfly and it gets, let's go all the way back to the beginning. Let's go all the way back to that first date here. What is the date? It's the Friday, March 8th. There we go. Okay. So if I put this on right now and the market ran right here, right to that strike, I'm just out. I'm not going to let it go all the way down to this level. And I can even zoom in a little bit more on this. But I'm not going to let it get to this point. But where your risk comes in at expiration is right where you skip that strike. Right where you skip it is where the additional risk goes in. So you can look at this 15-point wide. The same scenario applies on this strategy as the scenario about going 10 points wide or 15 points wide on the long call spread. But yeah.
Yeah. So, and last maybe question.
Okay.
Sid got more than 2 minutes out of Brian on that, which is good. So his moment was more than Brian's cheek and a pop or whatever that was. So Brian, did you see Sid's
chip in the chair?
You would have to be on an expiration day to realize a bigger profit. That scares me. Did you comment on that?
Yeah, no, I didn't. I'm saying you do in the SPX. Obviously, there's different dynamics based off of the amount of premium that remains in these option contracts. And that is scary. But you think about it, if you're in a short spread, you've already had to do something because it's really scary, right? It's not helping you out like it is here. Does that make sense?
Yeah.
So doing this, I'm saying we're already putting our hedge in by doing the skip strike butterfly. And what are we giving up? We're giving up 15 cents.
Okay. Yeah.
To me, it's a no-brainer, right? Because we looked at the spread. So this is trading for 70 cents, a net credit of 70 cents to the account, right? We see that by doing the skip strike. So let's go all the way back to that very beginning. We're going to leave the 580 and let's get rid of these. If this is an alternative to just doing a short spread, that's 80 cents, 90 cents. You know, you're talking about 30 cents difference, and you already have your hedge embedded. That, if the market moves against you at the end of the expiration, that's fine. So, Sid, one thing that you could do, and you're not going to bring in as much credit, is just do this one shorter. Okay, so let's let's see what we'd get on a March 13th, okay? March 13th here. One standard deviation is right about here. And we can set them up real quick. That's 17, 15. All right, we'll do, yeah, I think I would do this one. Mainly because it's going to be shorter and we might be able to get we're not going to get as much of a credit. So moving it up a little bit will help with the credit. Okay, so we're going to do shorter because if you think about it, Sid, then you got a little bit less risk in a weird way, in that if it does go against you, expiration comes quicker, if that makes sense. All right, so buy this, sell that, skip the 45, buy the 55. 55, that's not bad. 60 cents. That's maybe because we went down one. We're a little closer to the actual stock. I don't mind this. I don't mind this one at all. That's 5 days out. So you're doing it on a Friday. You got the weekend, which is scary. Gap open on a Monday would be scary. And they got 1, 2, March 8th. Yeah, this is Monday. This is all day Tuesday. End of the day, Wednesday. So now we go in, we send that to the what if calculator. You zoom in. Right? And now let's go 1 day forward. Let's go Monday. Monday, we're there. And now remember, this is 12:48. So it's taking the time into account. And I guess I did the 12th. No wonder why it moved that much. So there's the 12th, and then this would be Wednesday at 12:48 Eastern time. And then you're there, and then on Friday, it looks like that. Or at the end of the day, it looks like that. So another 4 hours, and then you're here.
All right. Well, Brian, thank you for being, as always, generous with your time and your analysis. I always love the detail. And thanks for getting, I did want to see a little bit of the skip strike. So I'm glad Brian got a chance for that. We got 2 for 1 today, which was very good. And so,
Yeah.
and we'll have Brian on, again, always, he's more than welcome, with us. And check out Brian's site. It starts this Sunday. That will be a big help to everybody.
Yeah, it'll be a brand new site this Sunday. So
Yeah.
right now, optionsplaybook.com is the old Options
Yeah.
Playbook that's been out there for many years. We did at one point in time, we used to have 1 million viewers to the site a year.
That's wild. That's wild.
Yeah.
So I think keep up on that. I think it's a great source of information on the strategies, and it's just very good. Anything Brian's doing, keep up with.
Yeah.
So thanks, Brian. Thanks for taking time with us. I appreciate it. And everybody will talk to you later.
I think we need, and I'm going to put the vote out there and put you on the spot. I think we need another Gleacher Day event. I'm just saying.
Yeah, I started talking about a Chicago seminar, and Brian would be my first call. So we'll hopefully we get something going soon. So thanks, Brian. Appreciate it.
Bye, everyone.
Thanks. Bye-bye.